Hello and welcome to another episode of the Real Estate Investing Club, the place investors go to learn tips, tricks, and stories from other investors in the field. Before I introduce today's guest, I have three short housekeeping items to cover. First, if you like our content, the best way to support us is simply to like, subscribe, comment, or share this episode with your friends and family. Second, we are active investors ourselves and are always on the lookout for mobile home, RV, mixed-use commercial, and multifamily properties in MSAs with a population of 100,000 or more. So if you are also an active investor and have something you think we may be interested in, we would love to take a look. Send us the details of the deal at www.therealestateinvestingclub.com. Third, if you are a new investor and would like to learn how to get started or scale your real estate investing business, go to www.therealestateinvestingclub.com to check out our course. So without further ado, let's dive right in. We have a very special guest with us today, so buckle up, grab your pen and paper, and enjoy the ride. All right, we are live. Today we have Cody Laughlin with us today, partner at Blue Oak Capital and the host of Prosperity Through Multifamily Real Estate Investing podcast. Cody, thank you very much for joining us today. How you doing?
Man, Gabe, I'm fantastic. I appreciate the honor, man. I'm privileged to come on your show, man. I appreciate having me. So looking forward to our conversation.
Absolutely. To get us going, why don't you tell everybody, who you are, where you're from, and how you got started in real estate in the first place?
Yeah, man. Yeah. So again, Cody Laughlin, managing partner over at Blue Oak Capital. My partner and I started our company earlier this year with a focus on apartment syndication. We're both based out of Houston, Texas, which is one of our primary markets we focus our investing efforts towards. And, my real estate journey started like many others in single family. Started about 10 years ago, back in 2010, when I became an accidental landlord.
I love it.
Yeah. So I had just started my professional career, W-2 career in 2008. And, everybody remembers that time, right? The Great Recession and just everything was just
best time to graduate.
Yeah, I was in the pits, man. And being young and naive, and I'm getting out there and I'm watching these people that were working 30, 40 years and just all their retirement was wiped out in a matter of 2007, 2010. And, just coming gung ho and right out of college, I'm like, okay, this doesn't make sense. Like I'm going to go beat the system. Right. So I'm going to start studying how to invest in stocks, how to invest in retirement accounts. And, I'm not going to be a victim, to this downturn. And along the way, again, fast forward 2010, my wife and I, we tried to sell our first house. And, again, the real estate market was in the pits and we ended up becoming accidental landlords. And so around that time, somebody observed me studying a book about stock investing or some sort. And they said, "Hey, have you read this Rich Dad Poor Dad book?" And I was like, "Nope, never heard of it." But the real estate Bible, that's exactly right. So, so picked that book up, man, read it, and it completely derailed me and changed my entire life and course to kind of, our focus now being real estate entrepreneurship. And so, fast forward, I still tried to treg along and do a couple things in single family. Started out, doing some wholesale, tried doing some single family rentals. And then I was introduced to multifamily in 2011. And, the unfortunate thing about being young, especially at that time, is and being so fired up about this new journey I'm about to go on, is just had this shiny object syndrome, man. I started just chasing any object or any opportunity that came my way. I mean, if you threw a silver lining on it at me, I'm like, yes, let's go.
Let's do it.
And then you couple that with, some career opportunities in my W-2 job that I took advantage of, thinking, hey, more income, going to be more investment capital to use. And what ended up happening is it ended up derailing me a little bit and taking me away from real estate. So, got sidetracked there for some time. And after several years of going through chasing all these different opportunities and whatnot, it kind of had to take a step back, and my wife sat me down and she's like, look, what are you doing? she was like, she's like, look, you need to get focused, man. You need to do something, whatever it is, and just pick it and do it. And, innately real estate was just always my passion. I mean, that's where it just made the most sense. And so got recommitted and refocused on only multifamily, just got away from all the other distractions, and got back on the single family course because I had a limited mindset of, well, I want to get to multifamily, but I'm not ready for it, or I can't do it, or I don't have the capital. And so got into single family and with the intent to go into single family flips, and realized very quickly that sucked.
Yeah. Many would-be flippers, they do their first one or two flips and they're like, wow, never mind about that one.
Yeah, man.
Man,
look, kudos to those who are successful at it. And there's a lot of people that are, but it's so much work, and it's so labor intensive. Mm-hmm. And it wasn't helping me achieve my goal, which was developing a portfolio of passive income, right? Of just cash flow. It was very transactional. And if you stop doing transactions, you're not making money. And so, I finally had a kind of like an epiphany moment, if you will, back a couple of years ago. I have 3 children, and my son is going into his last year of Little League baseball, and wanted to coach his team, or at least participate in coaching his team. And I couldn't because of my W-2 schedule, right? It just, the way my schedule works, it rotates and long hours, and it just took me away from that opportunity. And that was kind of the moment where it was like, you know what, like it's time to make a change. It was just a really big gut punch. And because, when we're going on this journey, the one thing that you're always taught is you have to identify your why. Why is it that you're going on this journey? Because if your mindset and your why is not powerful enough or strong enough, then you're going to be out of this business before you ever really get any momentum. And for me, it was my family, right? I wanted to be able to give. The reason why I'm doing this and going on this journey is to be able to get away from my W-2 and give my time back to my family. And after that moment, it just clicked, and it was like, you know what? I can't let this be an excuse anymore. I can't have this limited mindset, because my kids are not getting older. I mean, any younger. Time is definitely not slowing down. And if I'm going to do it, I need to do it now. It's time for me to make a move. And so made that transition to multifamily a year and a half ago almost. And, started studying, getting educated, got involved into a mentorship program, started networking, and then actually started passively investing while getting educated, and, just trying to learn from what others are doing in the business. And then I was fortunate to have met my business partner at the time, latter part of last year. And, we started collaborating with one another, and started bouncing ideas off each other, looking at deals, analyzing deals together. And then, we just really saw that this was a good fit. And we had some complementary skill sets and some things that we both were able to bring to the partnership, and say, hey, look, let's make this official. And here we are now in, mid 2020. And again, we launched our new company earlier this year, and, all focused on apartment syndication. So very long-winded answer. I'm sorry, but that's my story in a nutshell. So
no, I love your story. Honestly, it's like, I feel like a lot of people have been in your shoes. They've kind of experienced where you're at, or maybe they're in there right now. Like this, you're listening to this, you're watching this, and you're like, wow, his story is my story. This is where I'm at. Sounds like, you graduated in 2008, which ironically was the year I graduated as well. We went into the worst economy, known to man at the time, and just no jobs. And so I did the same thing. I jumped into the W-2 boat. I'd always wanted to be an entrepreneur, but I didn't do it. I jumped into the W-2 thing just like you did. And it looks like in 2010, you even had a house and you tried to sell it, but the market was so bad that you couldn't. Mm-hmm. So you got your first taste of real estate investing. You rented it, which is awesome. That's a really good foray into the industry.
Trial by fire.
Absolutely. Then you read the Bible. You read Kiyosaki's book, and got even deeper into it.
It looks like 2011, you really started your journey towards multifamily, but you got the shiny object syndrome, which is no shame there because I've experienced it. Everybody else has experienced it. It's really, you don't. It's kind of insidious because you don't really realize what's happening until you're like, crap, I haven't gotten anything done in the past 3 months. I've been chasing all these different things. So
That's right.
I love your story in that respect. In the flaws because it really is a reflection of what so many people are going through. But you've gotten focused now. 2017, you have 3 kids. You kind of had your epiphany. You're like, I got to make a change. Something's got to change. I can't keep going down this path. So you decided to focus on multifamily. And since then you found your partner, which is great. I'm huge fan or huge proponent of, creating partnerships, especially when you guys have complementary skill sets. I have a partnership as well with 2 other guys. And so that kind of brings us to today. And that's so I love your story. I love that you've gone through the shit. You've had a lot of years where nothing was happening, and now you've kind of focused in on what it is that you want, which is real estate or multifamily real estate investing. So great. That brings us to today. So I kind of want to go into the experiences that you've had so far to this point. You mentioned you did some flips, you did some wholesales. Kind of tell us what has been your experience in the real estate so far, for people listening, maybe just wanting to get started. How did you get started? Like, what was your first deal? And then how did you find that deal?
Yeah, well, again, I go back to 2010, my example of becoming an accidental landlord, right? When I tried selling that house and, when we couldn't, we ended up having to put a tenant in there and had no idea what I was doing about being a landlord, just nothing, right? And I was like, hey, I'm going to figure it out. Read the book and I was like, oh, this is what Kiyosaki says to do, right? And so, started with that and for about 3.5 years tried to be a landlord and I learned very, very quickly after those 2 experiences, those first 2 tenants, that I was like, yeah, I don't want to do this. I have no desire to be a landlord. I mean, chasing the tenants down for rent if it's late and having to, make service calls and deal with the issues and, showing up on holidays and weekends when something's going wrong. And then my second tenant, we had to go through an eviction process. And I remember, so I made the mistake, and this is for any of those hands-on landlords, if they're just starting, we're a people business, right? We service people, but you have to realize that too, this is also a business. And, especially professional tenants, as I like to call them, sometimes know the business and they know how to, work the system, if you will. And so I kind of got involved in the sob stories of my second tenant. And, it was every month it was a new issue and it was always, I was in the hospital.
I've been there.
Yep. Yeah. Right. So just something traumatic. And you're like, the human in you's like, oh man, that really sucked. It's like, okay, man, well, look, catch me at the end of the month or catch me next month. And then 6 months later, you're sitting in court trying to evict this tenant. And I remember we're going through the eviction process and the judge, the city judge, pulls me to his chambers after the court hearing. And he says, man, why'd you wait so long? And I was like, well, man, I gave him a little backstory or whatever. And he was like, no. he was like, this is a business and you have to run it a business. And he was an investor himself and he had a portfolio. So, he shared some wisdom with me there. And from that moment on, I realized, maybe I'm just not cut out to be the landlord. I'm a nice guy. I care for people and I can fall victim to that very easy. If you tell me your cat died, I'm like, man, that's, that sucks. So that kind of hardened me a little bit, but lo and behold, I got a property management on that single family home. And again, got into wholesaling during that time as well and tried that for a bit. And, wholesaling was, there's a lot of good potential there. There's a lot of different ways that you can make some significant capital through wholesaling transactions. But it just takes persistence and it takes a lot of patience and a lot of marketing effort, which, despite the importance of that in our business, cared to innately, I'm always kind of a more impatient person. Like I want something and I want it done now, And then, marketing is just not something that's natural to me, nor do I have a passion for it, if you will. So I realized pretty quickly on that just wasn't really my thing. So kind of ditched that. And then we got into the single family flips and really started getting into with wholesale companies that were, professional wholesalers that were actually doing this full time and, started sourcing deals that way. And, again, did that for a couple of years. And after that after the second flip, I was just like, yeah, it's just time to move on. And it's just really, again, time to step it up. And so now in the multifamily space, we were looking for the economies of scale, which is why we focus on apartment syndication. We wanted to go bigger and faster. My business partner, he is somebody who's passively invested in multifamily for 5 years now. I think he has over 2,000 units that he's invested in. And so he saw that potential as a passive investor. And, I passively invested in my first deal last year. And, while we was getting educated and learning about this apartment syndication model, really started to make that a focus. And so really in the deals that we're looking at that are closer to 100 units or 200 units, most of those deals you're going to source through brokers. And that's where we've been putting most of our effort into sourcing opportunities is through brokers. And my partner, he is leading a direct mail campaign in Tennessee, where he's from, trying to target some, mom and pop owners, if you will, out in that area. But most of our deal opportunities are coming through relationship with brokers. So.
Awesome. I love it. And yeah, I mean, there's a few things that I want to pick out of there before, I'd like to go into the model that you're currently focusing on, which is apartment syndication. But before we do that, you mentioned earlier, you kind of got out of, you didn't want to do the single family rental business. You didn't want to be a single family landlord because of the eviction. And I went down the same path as you. So again, no shame there. I had a tenant who, in the end, it was like $4,500 that she was back on payments. And so, when you get into real estate, you do, at least I did, I wanted to be a good landlord. I wanted to be an upstanding business. And so they'd come to me with all their problems that seemed very legitimate. And so I was like, okay, it's okay. Pay me next month and we'll create a payment plan for this. But she never paid, which is echoing exactly what you said. When you create a real estate business, make sure that you are creating a business and not a hobby, because you can be taken advantage of from the tenants. So just that was the point that I saw there. People out there who are just getting started, make sure that you are running it as a business, because it is a business, and that's how you kind of have to look at it. So then you went into flips. You mentioned that you got most of your deals from wholesalers. That's awesome. I like hearing good wholesalers out there. We deal with wholesalers as well, although we've noticed that a lot of their margins aren't quite what an investor would expect. But if you got good wholesalers, hold on to them. They're good as gold. So that's all I wanted to cover there. So let's go into your current model, apartment syndication. Mm-hmm. For those who, I'm sure a lot of people have already heard about this, already understand the model, but for those who do not understand apartment syndication or just syndication in general, kind of take us through the outline of what that is and how it works.
Yeah. So the basic premise of syndication, is, you're the pooling of other investors' capital to go purchase an asset that you really couldn't normally take down on your own, right? Whether it be from liquidity restraints or net worth restraints, whatever it is. It's the ability to kind of take down a larger deal in which you would require more capital to do so. And so I can go out and partner with however many investors, depending on which rich regulation exemption we fall under. And we could talk about that later. But anyway, I can go and partner with however many investors, and we can go take down a 100-unit deal versus having to maybe do just a 10-unit deal if that's all that's within my own bandwidth. And so it allows you the advantage of leveraging, other people's money, partnerships, and other people's net worth, liquidity, and all that things, to go bigger and faster. So,
yep. Absolutely. And as the syndicator, you guys are the operators. So you're, just to make sure that that's clear for everybody, when you're doing a syndication, there are people who are putting money into the syndication, and then there are the operators, and you create a equity split based on that. And so, Cody, you guys at Blue Oak Capital, you guys are the operators, and so you're looking to actually purchase. You said 100 plus multifamily.
Yeah, our focus. So going back to my example about being the landlord, right? Is neither my partner or I. We both are still W-2 employees. We're both husband fathers, and we neither one of us had that desire to be a hands-on manager, a property manager. So we wanted to have something that was large enough that could sustain third-party property management. So usually deals that are typically 60 units or larger can support that. And so our focus is really around 75 to 200 units is what we tell everybody. But, the closer, I'd say about 100 to 200 units is where we'd like to be at.
Awesome. I love it. And you've kind of touched on this already, but so you guys how are you getting these deals into your business? It sounds like you guys are doing brokers and direct mail, but the majority of your results are coming from brokers. Is that correct?
Yeah. Brokers, man. I mean, again, there's a lot of mom and pop operators out there or owners out there, I don't want to say that they're always just smaller deals. That's not true, but most of the larger deals, again, the 100 units or more that you're going to see are professionally owned by a company or other investment groups that are used to running these things as a business. And those transactions are typically going through brokers when they're ready to trade. So most of our deal flow is again coming from those broker relations.
Gotcha. Awesome. So when you guys see deals, first, well, let's go into the criteria a little bit. I mean, there are tons of deals out there. There's no shortage of them. The problem is you got to find a good deal. So how do you guys identify finding that deal and go into both the demographics, like the location that you're actually looking at, and the specific apartment building that you're looking at? What are you guys looking for in both of those respects?
Yeah, so you're absolutely correct, man. I think, right now, some would argue that this is such a crazy time to try to get into the apartment syndication world because, prior to COVID, you saw these just severely inflated valuations of some of these deals, and rightfully so. I mean, they were transacting and people were buying. I mean, multifamily has historically been one of the most resilient asset types to be invested in. And I think that's one of the biggest things that have attracted to it. So, when coming into the space in 2019, when we were starting to look at deals rather, and doing underwriting, I mean, it was hard to find anything that was penciling out. And then you have now COVID and the market for a little bit there kind of went flat. I mean, just nothing was transacting. There was no deals on the market. And if they were, they weren't the most stellar deals anyway. And then now things are kind of slowly picking back up, but I don't think we've seen any type of changes in the valuation. So, but to go back to your original question, it all starts with what your specific deal criteria is, and you have to be very well defined in what that criteria is. And so, when we look at our deals, it's not just the unit count, it's the age of the property. It's the, again, the size of the property, as you mentioned, the location, all the way down to specifics. You want to look at the type of roof. Does it have boiler chillers? The unit mix itself, things like that. We take all that into consideration, and then we dive really hard into the market itself. We really focus on primary and secondary markets that have a larger MSA area. I would say at least 150,000, a city population of 150,000 or more. And they have good, strong fundamentals. They have good job growth, a population growth, a diverse economy, a good, solid household median income. We'd ideally like to see above, $40,000-$45,000 per household. The unemployment rates. We look at the affordability gap and things like that. So really diving into the market specifics, and I would say that goes hand in hand with the deal criteria as well, right? You want to, it's easy to kind of get caught up and start looking at a million different markets, but you really don't become an expert at one unless you're sitting down and focusing only on that market and taking your time to really understand it. So we have two primary markets, right here in our backyard: Houston, San Antonio, Texas. And then my partner being from Tennessee, again, he's very, very familiar with those markets as well. So for him, it's pretty easy. So we're kind of looking over there, but just trying to stay focused within those markets. We understand them very well. We know the sub-markets very well. We know the historical trends, and we have our teams built there. So for us, we take those two into account, and then we start plugging away to see if we can make something happen.
Awesome. I love it. Yeah, I've heard, I've never invested out in Texas myself, but I have heard great things about both Houston and San Antonio. So sounds like you chose some good ones.
Yeah. Well, and the most important thing to add to that list of when we talk about market criteria is being in landlord and business friendly states. And you're seeing that a lot right now across the country, right? And in places like California, and this is not to plug at anybody in California, but I mean, you look at some of the laws that have recently been passed or some of the, legislation that's heavily weighed against the business owner. And it makes it even more challenging to make sense of investing there. Not saying that there's not deals and not saying there's not people that are successful, but just for us, it's like, you got to go where the money makes sense, right? You got to go where the deals make sense. And so we like to be in those landlord and business friendly states because going back to our example we were talking about earlier, where I don't want to have to be in court systems for a year trying to get a tenant out, all the meantime I'm having to eat that expense. I mean, as a business and a business transaction, if you got a tenant that you need to get out, you want them out and you want it turned so you can recapture that revenue and move past that. So that's important to consider as well.
Yeah, absolutely. And I've heard good things about Texas being a business friendly state.
Yeah.
Washington, where I'm at, is not so much. So I feel you on that. Awesome. So, you gave us a ton of criteria that you use to identify, a good deal, age, unit count, I don't know, you a whole litany of them. And that's great because you really do need to see the whole picture of a property before you buy. Let's go one step past that. So, you found the deal. It's a great deal. Now you got to find the money. So how do you guys go about raising the capital?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
Yeah, that's a great question. And so it all comes down to your network, right? And relationships. And I go back to say, this is a relationship business, and that includes building your team of both professionals and investors. And, ultimately we talk about this a lot, right? Where when it comes down to it, when you're bringing investors in to invest with you, they're ultimately going to invest with you, the person, right? The deal is a small part of it, but you, the person, is the bigger part of it. And they want to know that they can trust you to protect their money, return their money, and do what you say you're going to do, which is perform. And the only way for people to really trust and start building that relationship with you, it takes time. And so what most of our relationships come from investors that we have met through networking events. We host our own Meetup. We've been doing that for a year. Being in Houston, there's a bunch of meetups and local different RIA type events. And so we're always going, a large group of us are all going to the same events and same people. So we're seeing a lot of the same faces and really getting to build that relationship that way. And in any time that we are, going out to just the general community and just meeting people, just trying to figure out who people are. And when we get the opportunity to speak to real estate and we find out people are interested, we really dive into that and really try to get them, introduced to what we're doing and see if it's a fit, but it takes time. Again, it's ongoing. You have to have, I tell people you have to have multiple touch points, and to do that and just keeping engaged with people. But I guess to sum up the answer to your question is really through networking events is where we find a lot of our investors. And then we keep them in our database and we try to nurture those relationships over time. That way, when we do have a deal ready, we have an understanding of what their investment criteria is, if it's a fit for us. And then, we present that and hopefully it's a partnership that we can move forward on.
I love it. Awesome. And yeah, I mean, one thing that I really took from that, besides the fact that, I mean, you guys are really focused on relationships, which is great, is that, investors, when they want to give you their money, they're not necessarily giving you because of the deal. They're giving it to you because they trust you. They like you. They want to invest with you as a person, and not as some, faceless entity. So I love that when you're trying to raise capital, networking is number one, but make sure that you're doing it correctly. You make sure that you're building relationships and you're not just doing transactions. So I love that.
If I can, Gabe, I always like to throw this out there anytime that we're talking about this is like, this whole idea of find a good deal and the money will come is, especially beginning when you have no relationships and you don't have a lot of that ongoing touch points with people and they don't know you, that's so further from the truth. I mean, if maybe you're a Neil Bawa or Hunter Thompson, some of these other guys that I love to follow, and those guys have a successful track record. They may not have as much trouble, going out there and finding new investors, but or finding investors to come to a deal and maybe never have met them, and they can do that with the type of deals that they're doing. But for some me who maybe for the first time they're hearing me on your show, they don't know who I am. I mean, they have no idea who I am. So why would they give me $50,000 or $100,000 of their money? Nor should they. Should they? Because and so this idea of go find a great deal first. I highly encourage people you should always be working to find deals, absolutely, because they're very hard to find, especially in the market now. But you should always be focusing on building your investor database and nurturing those relationships. So that way, when you do find the good deal, do you have the key pieces in place? But if you're just focusing on the deal and not the database, you're not going to get anywhere, and in particular in the apartment syndication space. So,
yep, I love it. That is great advice. So we are, we try to keep these around 30 minutes, or at least I've been trying. I never make it, but I try to keep it around 30 minutes. So we are closing in on the end here. Before we go, though, I always ask people the same question. If you were to go back to the Cody who started, just graduated 2008, so much energy, getting out there, ready to take on the world. If you could go back to him and give him one piece of advice going forward in real estate, what would that piece of advice be?
Stay focused and disciplined. Because I tell you, I was introduced to multifamily in 2011, and I missed, in my opinion, probably one of the best times ever to buy multifamily real estate, real estate in general, but multifamily real estate in particular at that time. People were getting in deals then, and I mean, you can make a lot of mistakes and recover just from how much the market appreciated in those few years. And so I look back and I'm like, God, dog, like that way, I missed such a good opportunity, all because I just got, I was unfocused. And so staying focused and disciplined is huge. And listen, it's a long-term game. I think people need to understand this. It's a long-term game if you're going to build this business over time. And take your time. It's okay to take your time. And things aren't going to always come at you immediately. And speaking to multifamily in particular, things don't happen overnight. And, it's not a get rich quick type of game. And so you can't get distracted or disappointed in that, oh, well, man, I'm not getting any deals this month, or, oh, this didn't happen, or whatever. You have to stay focused on the end goal, and you have to stay disciplined, identify your criteria, stick with it, and don't deviate. So.
Absolutely. Stay focused and disciplined. Couldn't give any better advice myself. Awesome. Well, Cody, thank you for coming on. I appreciate, sharing all the wisdom that you've shared with us so far. You've given us a lot, and so we always need to give something back. So if somebody were to give you something, be it a deal, be it a relationship, anything, what would you want to receive?
Relationship, man. I'm very big on the networking. I love meeting new investors and just trying to help discover what people's interests are and see if we can help one another. I mean, that's that's one thing I love about this space is everybody's willing to give back and help one another out, you know, and you know, when you take this team approach and you realize that, you know, you can get so much further when you're giving value to other people, it just will help accelerate you so much more. So I would love the opportunity to meet anybody that loves talking about commercial real estate and apartments in particular. So
cool. And on that note, if somebody did want to get in contact with you, what would be the best way for them to do that?
Yeah, man. So you can check us out. I'm very active on social media. You can check out my Facebook page. I really particularly very active on LinkedIn. You can check me out at Cody Laughlin. You can follow our company Instagram page at Blue Oak Capital. And then email me at cody@blueoakinvest.com. And that's invest with an S. Or you can, hit me up, text message or phone call, 337-794-8283.
There you go. You heard it from him. So if you want to get in contact with Cody, reach out at any of those things he just listed, Cody@blueoakinvests.com. I will also put his LinkedIn URL in the show notes. So if you want to reach out there, you can go ahead and click through there. So again, Cody, thank you for coming on the show. I really appreciated it. For everybody listening and watching, thanks for joining us today. Again, the best way for you guys to support the show is just to like, subscribe, and share with your friends and family. Other than that, we look forward to seeing you guys on the next episode.
Thanks, Gabe.
Thank you for joining us on the Real Estate Investing Club. If you feel we provided value, we would appreciate it if you hit that thumbs up, share it with your friends online, whatever it may be. If you'd like to share or partner with us on an investment deal, we are always looking for quality projects. Go to www.therealestateinvestingclub.com to get in contact with one of our partners. Otherwise, I hope you guys have an absolutely fantastic day, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.